Wall Street is celebrating a green finish on the Dow, but they are completely ignoring a multi-trillion-dollar time bomb ticking away right underneath them. While everyone's eyes are glued to Nvidia's upcoming earnings and the countdown to Jackson Hole, the 10-year Treasury yield is holding dangerously close to 4.7%. Long-dated borrowing costs are squeezing liquidity, trade wars are flaring up, and retail giants are stumbling. If you think this is just a routine market pullback, you are walking straight into a trap. Let's break down what's actually happening beneath the surface and how you should position your portfolio before the next shoe drops. To understand why this market feels so heavy, we have to look at the macro data hitting the tape. Last week gave us a stark reminder of how fragile things are. The S&P 500 slid from its highs, weighed down by sticky inflation data and a massive bond market squeeze. Look at the 30-year Treasury yield. It recently tested multi-year highs near 5.3% before the U.S. Treasury had to step in with double-sized bond buybacks just to keep the plumbing from freezing up. When long-term yields stay this high, it changes the entire math of the financial system. Borrowing costs for businesses and consumers skyrocket. We saw this reality bite hard when retail bellwether Walmart posted soft sales growth, sending shockwaves through consumer discretionary stocks. At the same time, the tech sector, the undisputed engine of this entire bull market, is hitting an air pocket. Mega-cap tech names are seeing massive capital expenditure spending outpace cash flows, and investors are starting to ask, when do these AI infrastructure investments actually start paying a return? Add on top of that fresh geopolitical friction, like Washington slapping 50% tariffs on Canadian goods and retaliatory measures taking shape, and you have a recipe for severe cross-asset cross-currents. So what does this mean for you? Whether you're managing a crypto portfolio, trading Forex, or building a long-term stock basket, first, recognize that smart money is rotating, not retreating. When bond yields spike and tech valuations get shaky, capital doesn't just vanish, it migrates. We've seen gold surge past historic resistance lines as institutional investors seek safety away from currency devaluation and fiscal uncertainty. Defensive sectors are catching bids while high-flying growth stocks face a reality check. Second, watch the upcoming catalysts. Federal Reserve Chairman Kevin Warsh's keynote at Jackson Hole is live wire risk. If the central bank signals that rates are staying higher for longer to fight stubborn inflation, growth multiples will compress further. For young investors and long-term builders, this environment isn't a time to panic. It's a masterclass in market cycles. High interest rate regimes expose weak business models and reward disciplined balance sheets. Focus on cash flowing assets. Avoid over-leveraged growth traps. Keep dry powder ready for when sentiment overcorrects. If you want to stay ahead of these macro shifts instead of finding out about them after the market moves, you need to look at the data before everyone else does. Hit that subscribe button right now, turn on notifications, and drop a comment below. Are you rotating into defensive assets, or are you buying the tech dip? Full breakdown charts are waiting for you on the channel. See you in the next lesson.